New banking reforms in Iraq, a game changer for the IQD. Welcome back to the Iraqi Dinar Alert. Iraq's financial architecture has long been burdened by legacy problems, a banking sector fragmented between weak state-owned banks and undercapitalized private lenders, pervasive cash dependency, gaps in compliance and anti-money laundering (AML) controls, and near-total reliance on oil for fiscal revenues. Over the last 2 years, the Central Bank of Iraq (CBI), with support and encouragement from international institutions, has launched a multi-pronged reform program designed to transform the banking system, restore correspondent banking relationships, and modernize payments and supervision. But the central question for ordinary Iraqis, traders and FX markets is, will these reforms be a genuine game changer for the Iraqi dinar IQD? This article explains what the reforms are, why they matter, how they could affect the IQD in the short and medium term, and which risks could blunt the reforms' impact. What exactly are the new reforms? Broadly speaking, the reforms consist of 5 interlocking pillars. 1. Strengthened regulatory and supervisory framework. The CBI has issued a standards booklet and a set of upgraded prudential requirements for governance, capital adequacy, liquidity, and risk management. Banks must modernize internal controls, tighten board governance, and adopt robust risk frameworks. These steps are designed to bring Iraqi banks closer to global best practices. 2. Resolution of AML/CFT weaknesses and correspondent banking restoration. Iraq has been subject to intense international scrutiny due to weaknesses in AML/CFT, anti-money laundering, counter-terrorist financing controls, and some banks' links to illicit flows. The reform package includes stronger AML obligations, transaction monitoring, and an enforcement push that has already led to sanctions. Several local banks were restricted from conducting US dollar transactions pending remediation. Restoring correspondent banking lines is an explicit objective. 3. Digital transformation and payments modernization. The CBI's strategy promotes electronic payments, digital banking, and a long-term, digital dinar, roadmap. The idea is to reduce cash dependency, improve financial inclusion, and speed up settlement times from weeks to same or next day in interbank and cross-border flows. 4. Restructuring state-owned banks and market liberalization. The reform plan envisions governance overhauls at public banks, tighter oversight of state bank lending practices, and gradual measures to push credit allocation toward private sector projects that boost growth and diversification. International advisory firms have been engaged to help design and implement parts of this program. 5. Financial inclusion and retail banking expansion. A National Financial Inclusion Strategy 2025-2029 sets targets for bringing more citizens and SMEs into formal banking, expanding microfinance, and rolling out low-cost digital services. This seeks to broaden the deposit base and reduce the enormous informal cash economy. Taken together, these elements show a coherent reform blueprint: fix the plumbing, supervision and AML, digitize the rails, payments and digital banking, and restructure the players' public bank governance and private sector credit. The question is whether the reform design is deep enough, and will be implemented quickly and credibly enough, to change market expectations about Iraqi currency stability. Why these reforms matter for the IQD. To understand the connection between banking reform and the dinar's prospects, it helps to trace the main channels through which reforms can influence currency dynamics. 1. Restoring access to foreign currency and correspondent banking. Iraqi banks have suffered restrictions on dollar transactions because of AML concerns. These restrictions reduced banks' ability to source and pass on foreign currency, raising FX market fragmentation and pressure on the informal market. Credible remediation and restored correspondent relationships reduce FX shortages and volatility. Reuters reporting and official statements shows that banks have been or risk being banned from USD transactions, underscoring how critical AML remediation is for FX access. 2. Reducing dollarization and cash dependency. Higher use of electronic payments and retail accounts broaden the on-balance sheet deposit base. When more economic activity flows through banks, central bank policy tools and FX interventions become more effective. The financial inclusion agenda and digital payments reforms are aimed exactly at this structural shift. 3. Improving macro policy credibility. If the CBI can demonstrate independence and sound governance, tighter bank supervision, lower fiscal financing through central bank balance sheet operations, and greater transparency, market confidence improves. Expectations of lower policy missteps reduce exchange rate risk premia and speculative pressure. 4. Channeling credit to productive sectors. Over time, better governance in public banks and stronger private banking can expand credit to the non-oil economy. A diversified economy with broader exports, higher non-oil revenues and stronger domestic demand reduces the IQD's exposure to oil price shocks. 5. Lowering systemic risks and currency runs. Stronger capital and liquidity rules make the banking system less run-prone. That lowers the probability of panic-driven FX runs which have previously forced the CBI to take emergency measures that can hurt the currency. So the reforms attack several root causes of exchange rate fragility: FX access, liquidity fragmentation, cash dominance, weak governance, and limited private credit. But that theoretical improvement needs real, sustained implementation to affect the IQD materially. Short-term outlook. Cautious improvement, not a miracle. In the short term, weeks to 12 months, the reforms are unlikely to produce a seismic revaluation of the IQD. Here's why. Implementation lags are real. Rules, standards and new supervision frameworks take time to roll out, staff to be trained, and systems to be upgraded. International advisors can accelerate design, but enforcement takes months. The CBI's recent standards booklet and reform timetable are concrete steps, but they themselves note staged, multi-year implementation. Immediate pain from enforcement. Tightening AML and cutting off non-compliant banks from dollar channels has a short-term cost. Reduced FX liquidity at some banks and a potential uptick in market fragmentation while counterparties shift. Historical episodes show such measures can temporarily increase volatility even as they improve fundamentals. Reuters' coverage of banks banned from USD transactions highlights this trade-off. Enforcement can restrict FX flows before the benefits of restored international confidence are realized. Macro and fiscal constraints. Banking reform cannot on its own solve large fiscal deficits or oil revenue volatility. Until Iraq substantially narrows its fiscal gap or diversifies revenue, FX reserve positions and budget management will still weigh on exchange rate stability. IMF assessments emphasize that macro and structural reforms are complementary and necessary. Therefore, expect an initial phase of bumpy improvements, some FX market stabilization where correspondent lines are restored, but still vulnerability to oil shocks or rapid fiscal slippages. Medium-term impact 1-3 years credible. Upside for the IQD if reforms stick. If the reform program is implemented steadily and credibly over 12 to 36 months, the case for a meaningful improvement in the IQD strengthens. 1. Repaired correspondent banking and improved FX liquidity. Successful remediation of AML, CFT weak points and disciplined supervision should allow previously restricted banks to resume normal USD transactions and rebuild balances with foreign correspondents. That materially eases constraints on FX supply and lowers the premium on dollars in informal markets. International reporting and CBI statements indicate restoration of relationships as a core objective. When this happens at scale, it reduces structural FX shortages. 2. Lower FX market fragmentation and faster settlements. Electronic clearing, real-time payments and improved interbank settlement will reduce settlement delays that can otherwise create artificial shortages. Faster netting and interbank liquidity management allow the central bank and market makers to smooth spikes. The central banking coverage of the reform program notes efforts to modernize rails and improve productivity. The more efficient the payments system, the less prone the FX market is to episodic stress. 3. Stronger domestic deposits and lower reliance on short-term foreign funding. Financial inclusion that boosts savings rates into banks increases local currency deposits, reducing the need for risky foreign borrowing that can pressure the exchange rate when conditions shift. 4. Improved investor sentiment and potential inflows. As governance and AML standards improve, foreign banks and investors become more willing to take exposure to Iraqi financial assets and projects. Even modest-scale re-engagement by foreign banks or multilateral financiers can help by broadening FX supply and adding hedging capacity. If these medium-term mechanisms operate, the IQD should experience lower structural volatility, more predictable exchange rate management by the CBI, and a gradually stronger public perception of dinar stability. That said, an outright revaluation, i.e., a materially stronger official IQD value versus USD, would require sustained macro improvements, fiscal consolidation and reserves management in addition to banking success. What could derail progress? Reforms face several important risks. Political interference and governance backsliding. Implementation requires political will to resist capture by vested interests. Public banks with political ties may resist governance changes, and enforcement against powerful entities is sensitive. Incomplete AML remediation and continued sanctions. If banks fail to address compliance gaps, correspondent lines and payment networks remain constrained. Reuters and other outlets reported concrete bank restrictions. These demonstrate both the problem and how enforcement can create near-term pain. Continued failure would keep outflows constrained and FX markets stressed. Oil shocks and fiscal slippages. Banking reform cannot insulate the IQD from sharp drops in oil revenue. A sudden drop in oil prices or production can quickly pressure reserves and undermine confidence unless fiscal buffers are adequate. Operational and capacity constraints. Banks need technology, trained people, and robust internal controls. Rapid digitalization without proper cybersecurity and oversight could create new vulnerabilities. Regional geopolitical risks. Iraq's geopolitical balancing act, between the US, Iran, regional partners and global markets, injects extra uncertainty that can affect foreign banks' willingness to return or expand operations. These risks mean investors and policymakers must maintain momentum on reforms while building buffers and communicating transparently with markets. Practical implications for different stakeholders. For policymakers, CBI and Ministry of Finance prioritize credible, phased implementation with clear timelines, communicate progress metrics e.g., number of banks that meet AML thresholds, restored correspondent relationships, coordinate monetary and fiscal policy, reserve accumulation and disciplined budget management, amplify reform credibility. For commercial banks, invest in compliance, governance, and IT. Banks that proactively meet CBI standards will gain competitive advantage, access to dollar channels, correspondent banking, and corporate business. Those that lag risk operational restrictions and reputational harm. For businesses and exporters, expect gradually faster payments, lower transaction costs and a more predictable FX market if reforms stick. Exporters should plan to use formal channels more aggressively as correspondent access improves. For households and savers, financial inclusion pushes, more branches, mobile banking, and low-cost accounts will widen access to savings and reduce dependence on cash. Over time that could mean safer savings and better lending products for mortgages and small business loans. For FX speculators and investors, the playbook changes from betting on disorderly revaluations to monitoring reform implementation metrics, fiscal discipline, FX reserve trends, and oil revenues. Volatility may remain in the short term. Prudent investors will watch the pace of correspondent banking restoration and AML remediation. Scenario analysis. Outcomes for the IQD. To make the possibilities concrete, consider 3 plausible scenarios over the next 24 months. 1. Baseline. Gradual improvement most likely if reforms proceed but not perfectly. Implementation continues but with normal delays. Majority of major private banks meet standards and regain some USD access. Payments modernize and deposits grow slowly. IQD volatility declines, official rate is managed with occasional small adjustments. Probable IQD effect. Modest strengthening in market confidence, narrower spreads between official and parallel rates, but no abrupt revaluation. 2. Optimistic. Credible success if reforms are rigorous, AML gaps closed quickly, fiscal discipline improves. Fast AML remediation, restored correspondent banking across the sector. Digital payments scale fast, boosting deposits and lowering dollarization. Fiscal consolidation and improved reserves management. Probable IQD effect. Clear reduction in exchange rate risk premium and sustained appreciation pressure on the informal market. Central bank has more room for gradual policy normalization and potentially a managed narrowing of the official market gap. 3. Pessimistic. Reform stalls or is undermined. Political resistance, slow remediation, more banks lose USD access or face sanctions. Oil revenue shock or fiscal slippage. Probable IQD effect. Renewed volatility, possible depreciation pressure and widening of parallel market spreads, central bank forced into stopgap measures. These scenarios illustrate that reforms can be transformative but are not a guaranteed, immediate cure. Success depends on implementation depth and concurrent macro stability. What to watch metrics that signal success. Investors, journalists and policymakers should closely monitor. 1. Number of banks restored to full correspondent banking access, a direct marker of FX market normalization. 2. CBI progress reports and standards compliance statistics, how many banks meet capital, liquidity and governance thresholds. 3. Trends in electronic payments volume and retail account growth, indicators of reduced cash dependence and larger deposit base. 4. FX reserves and reserve coverage metrics. Stronger buffers reduce exchange rate vulnerability. IMF and CBI reports are key. 5. Fiscal performance versus targets, budget deficits, non-oil revenue mobilization and public wage trends. IMF staff assessments are a good source. Clear improvements in these 5 indicators would suggest that reforms are materially improving the IQD outlook. Policy recommendations: how Iraq can increase the odds of success. 1. Publish transparent, time-bound compliance milestones. The CBI should issue a public timetable of reforms and bank compliance status. Transparency builds market trust. 2. Prioritize AML/CFT capacity building. Fund and train compliance units inside banks and at the supervisory authority. Use international technical assistance only to transfer durable capacity rather than just short-term fixes. 3. Strengthen public bank governance immediately. Appoint independent boards, disclose loan books, and limit directed lending. Clean governance at public banks signals seriousness. 4. Coordinate fiscal and monetary policy. Avoid using central bank financing of the budget. Set clear fiscal consolidation targets tied to reserve objectives. 5. Accelerate retail payments adoption via incentives. Tax or fee incentives for electronic payments, and public services paid on digital channels, quickly boost adoption. 6. Engage foreign correspondent banks actively. CBI should host regular dialogue and publish remediation progress to reassure counterparties. 7. Mitigate social impact. Some enforcement and restructuring will create short-term disruptions. Use targeted social safety nets and liquidity support programs to ease transition costs. If these steps are followed, Iraq's reforms will be both deeper and more resilient, increasing the chance of a stronger, more stable IQD over time. Conclusion: a realistic, conditional optimism. The CBI's reform program represents one of the most consequential attempts to modernize Iraq's financial sector in decades. If implemented credibly, the program can repair correspondent banking relationships, reduce dollarization, expand the deposit base, and improve the monetary authority's ability to manage the exchange rate. Those outcomes would materially improve the structural outlook for the IQD, lowering volatility, shrinking parallel market spreads, and supporting a more predictable monetary regime. However, the reforms are not a quick fix. Enforcement can cause short-term pain. Political economy constraints may slow progress, and macro fundamentals, especially oil revenue stability and fiscal discipline, remain decisive. For the IQD to be a true game changer, banking reform must be paired with consistent fiscal policy, independent central bank action, and measurable progress on AML/CFT remediation. Markets will reward credible, measurable progress, and punish half measures. Appendix: key sources and further reading. Central Bank of Iraq, CBI Standards Booklet and Reform Documents, CBI Releases and Standards. Reuters, reporting on banks banned from USD transactions and enforcement developments. IMF, 2025 Article 4 Mission Statements and Staff Reports on Iraq's Macroeconomic Outlook and Reform Recommendations. Central Banking, coverage of CBI's partnership with Oliver Wyman and sector modernization efforts. Alliance for Financial Inclusion, CBI Press, National Financial Inclusion Strategy 2025-2029.